Welcome back, everybody. Today, we're going to be diving into some really, really fascinating ideas about risk and volatility in financial markets. We'll be taking a look at riesgo y oportunidad en la volatilidad, el todo y el infinito,
Oh, wow.
which is risk and opportunity and volatility, the all in the infinite,
Okay.
by Coe 51 Zen. And get ready to kind of rethink how you view risk, especially that tricky idea of confusing what's finite with what's infinite.
Yeah, Code 51's it really hits the nail on the head with that all versus infinite concept. It's amazing how often we kind of misinterpret risk, especially in a fast-paced world like finance.
Yeah, and I think that's what makes this deep dive so valuable, right?
Yeah.
And we're going to try to equip you with the tools to navigate these kind of choppy market waters with more confidence and avoid those common pitfalls that we all fall into.
Right. And one of the first things that Code 51's tackles is the difference between value and price. And that can be confusing, right? We see those daily price swings and we can get caught up in the frenzy. But true investors, they're looking at the inherent value of an asset, not just the ticker tape.
It's like those vintage record collectors, right? I
Right.
mean, they're not chasing the latest pop song. They're searching for that rare vinyl, that hidden gem that has that lasting value.
Exactly. And so short-term speculators are all about price chasing quick profits. But long-term investors, they're value-driven. They know that real value often takes time to unfold.
Speaking of time, how does volatility fit into all of this? I mean, just the word itself tends to make investors a little bit jittery.
Well, think of volatility as the degree prices fluctuate over time. It's like the ocean, always moving, with waves of varying sizes. And here's the thing, it's a natural part of the market. Even when things seem calm, there's always an underlying current of volatility.
So even in those seemingly calm periods, there are things happening kind of beneath the surface that can cause those sudden shifts.
Absolutely. A whole host of factors contribute to this constant dance. Geopolitical events, central bank decisions, even investor psychology, they all play a part. Imagine a flock of birds suddenly changing direction. Each bird might act individually, but collectively, they create a volatile pattern.
Okay, that's a great visual. But I'm still a little bit fuzzy on the difference between volatility and risk. Aren't they basically the same thing?
Well, you know, COA 51's uses the Royal Spanish Academy's definitions to clarify this, which I find really helpful. Risk, they say, is a contingency or proximity of harm, meaning the potential for loss. Volatility, on the other hand, is the instability of prices in financial markets.
So volatility is that price swinging up and down, and risk is that chance you'll actually lose money because of those swings.
Precisely. But here's where things get even more interesting. We need to consider the role of noise and bias in how we perceive and react to market movements.
Oh, this reminds me of Daniel Kahneman's work. He talked about how that confirmation bias can kind of lead us astray. We tend to seek out information that confirms our existing beliefs, even if those beliefs are shaky. So someone who is convinced that a stock is going to skyrocket might only focus on the positive news and ignore warning signs. So that's confirmation bias in action, right?
Absolutely. And when you add to that the constant noise of the market, all those random events and fluctuations, it's no wonder we sometimes make less than optimal decisions. Imagine trying to hit a bullseye on a target that's constantly moving while wearing a blindfold. Some misses might be because your aim is off, that's bias, while others are due to the target's unpredictable movements, that's the noise.
Okay, so we're battling both internal biases and external noise in the market. But how does this connect to Coe 51's idea of the all versus the infinite? That sounds pretty philosophical for a finance discussion.
It's incredibly relevant, actually. Chesterton, who COE 51's quotes, said, "The all is enemy of the infinite." Basically, everything has limits, even in a world that seems limitless.
So you're saying we often fall into the trap of seeing infinite growth when it comes to investing, like assuming a company's success will just keep going and going.
Exactly. Think of NVIDIA. They've had phenomenal growth with AI chips, and it's tempting to think this trajectory will continue forever. But even the most successful companies, they eventually hit ceilings, they face competition, changing markets, unforeseen challenges.
So how do we avoid falling into that trap of assuming that infinite growth? Where do we even begin to differentiate between what's finite and what's potentially infinite when making investment decisions?
Well, COE 51's provides a great example with the Puig brand IPO, which I think a lot of people found surprising. It really highlights the need to look at historical data and assess risk carefully, especially when the hype train is leaving the station.
Oh, I remember that IPO. Wasn't the main argument for buying into Puig brand coming from people selling this? I mean, they were pushing this infinite potential narrative,
Yeah.
even though the company's history didn't necessarily back it up.
You nailed it. They went public with a very high price-to-earnings ratio, which basically means investors were paying a lot for each dollar of profit the company was generating, and the sector itself was facing headwinds at the time.
Wait, can we back up for a second? For those of us who aren't finance whizzes, what exactly does a price-to-earnings ratio tell us? And why is it important when assessing risk?
Sure. The price-to-earnings ratio, or PE ratio, is a way to measure how much investors are willing to pay for a company's earnings. You calculate it by dividing the company's share price by its earnings per share. A high PE ratio often suggests that investors are very optimistic about the company's future growth prospects.
So in the case of Puig brand, investors were betting on massive growth, even though the data didn't necessarily support that.
Exactly. And while the sector eventually did see some improvement, Puig brand's growth turned out to be much more modest. This illustrates a crucial point. Even within a booming sector, not all companies will perform equally well.
Okay, that makes sense. So even within a general trend, we need to be looking at individual companies and not just assuming they'll all rise with the tide. But what about other types of risks, like geopolitical risks? Those seem much harder to quantify, almost infinite in scope.
That's a common perception for sure. Geopolitical risks can feel overwhelming, especially with all the news about potential conflicts and global instability. But even major events, like wars, tend to operate within certain boundaries.
So even these massive, unpredictable events could be considered finite in some way. I'm really curious to hear how you explain that.
It's about recognizing that even within chaos, there are often limits and objectives. Consider Churchill's leadership during World War II. He acknowledged the possibility of immense loss, but he also framed the conflict as a fight for survival with a defined scope and purpose.
That's a powerful example. He wasn't sugarcoating the potential for suffering, but he also wasn't letting the fear of the infinite paralyze him. He focused on the achievable goal of survival against a very specific threat.
Exactly. It's a great reminder that we often overestimate the scope of potential risks, especially those that seem distant or abstract. This brings us back to the all versus infinite idea. We can't predict the future with certainty, but we can try to assess risks within a realistic framework, acknowledging that even the most daunting challenges often have limits.
This is all incredibly insightful. But we've mainly talked about the trap of assuming infinite growth. What about the flip side? What about when we assume infinite risk? How does that play out in the world of investing?
That's where things can get really dangerous. If we perceive a risk as having potentially catastrophic, even infinite costs, we might make overly cautious decisions. Even if the probability of that risk happening is low, the perceived infinite cost can paralyze us.
It's like refusing to ever drive a car because of that tiny chance of getting into a fatal accident. The risk is real, but the perceived infinite cost shouldn't prevent us from leading our lives.
Exactly. It's about finding that balance between acknowledging real risks and not letting the fear of improbable but catastrophic events control our decisions. And this is where understanding the difference between the all, the finite, and the infinite becomes crucial for making sound choices.
Okay, we've covered a lot of ground here. We've talked about value versus price, the ever-present nature of volatility, the impact of noise and bias, and the importance of distinguishing between the all and the infinite. That's a lot to digest. Before we move on to specific strategies for managing risk, I think it's time to hear from you. What are your key takeaways so far? What resonates with you the most?
It's fascinating how our perception of risk can influence our decisions. Even when we're dealing with something as tangible as money, sometimes that fear of infinite loss can be way more crippling than the actual risks we face.
That's a great point. And it brings us back to something Coe 51's talks about the dangers of assuming infinite risk. He uses the story of the sorcerer's apprentice to illustrate this. Have you ever felt like that apprentice trying to control something really powerful, but not fully understanding the consequences?
Oh, it's a classic tale of hubris and unintended consequences. The apprentice tries to use magic to simplify his chores, but ends up unleashing a force he can't control.
Exactly. He thinks he's found this shortcut, but it backfires spectacularly. And Coe 51's argues that we often see a similar dynamic in financial markets. When we chase those get-rich-quick schemes or buy into hype without understanding the underlying fundamentals, we risk becoming the sorcerer's apprentice.
Yeah, it's that allure of easy money, the belief that we can outsmart the market and avoid any negative consequences. But just like the apprentice's enchanted broom, unchecked speculation can quickly spiral out of control.
So how do we avoid falling into that trap? How do we recognize those situations where we might be overestimating our control and underestimating the potential risks?
It all starts with humility, really. recognizing the limits of our knowledge and being honest with ourselves about the potential for things to go wrong.
So a healthy dose of skepticism is in order, not just about the market itself, but also about our own abilities to predict it and control it.
Absolutely. It's about understanding that we don't have all the answers and that even the most seasoned investors make mistakes. There's always an element of uncertainty, and that's okay.
And that doesn't mean we should just shy away from taking risks altogether. Right?
Yeah.
I mean, there's a difference between reckless speculation and calculated risk-taking.
Exactly. Taking calculated risks is part of the game. But those risks should be based on solid research, a clear understanding of the potential downsides, and a well-defined investment strategy.
So it's about shifting our perspective from the infinite, those unrealistic expectations of limitless growth or control, to the all, the finite reality of the market with its inherent limitations and potential for both gains and losses.
You got it. And that shift in perspective can be incredibly empowering. It allows us to make more informed decisions, manage our expectations, and navigate the ups and downs of the market with greater resilience.
Hmm. I'm starting to see how these seemingly abstract concepts can actually be applied to real-world situations. It's not just about picking stocks. It's about making sound decisions in all areas of life. We all face those moments where we're tempted by the quick fix or the promise of effortless success.
Absolutely. The temptation to chase the illusion of the infinite is everywhere. It's in the way we consume information, the way we set goals, even the way we approach our relationships. Think about those too good to be true promises we often encounter. They often prey on our desire for a shortcut, for a way to bypass the natural limits and challenges of life.
So the challenge is to kind of cultivate that discerning eye, that ability to see through the hype and recognize the limits, the boundaries, even the potential pitfalls that lurk beneath the surface of those seemingly limitless opportunities.
You're exactly right. It's about developing a healthy skepticism, a willingness to question assumptions, and a deep understanding that even in a world of constant change and innovation, some fundamental truths remain constant.
And one of those truths is that nothing lasts forever, right? I mean, even
Yeah.
the most successful companies, the most powerful empires, they eventually face decline.
Exactly. That's the nature of cycles of ebb and flow. Recognizing that inherent impermanence can actually be incredibly liberating. It frees us from the illusion of control, the burden of chasing the unattainable.
So it's about embracing the reality of the all, as Koei 51s puts it, and finding freedom within those limits.
Yeah.
But how do we do that without becoming overly cautious or risk-averse? How do we find that sweet spot between prudence and boldness?
That's a great question, and it's one that many investors grapple with. I think it starts with understanding our own risk tolerance, our own comfort level with uncertainty. Some people are naturally more risk averse, while others thrive on taking chances.
And there's no right or wrong answer here in educating. It's about finding what works for you for your individual circumstances and goals.
Precisely. It's about developing a personalized approach to risk management that aligns with your values, your financial goals, and your overall outlook on life. For some, that might mean taking a more conservative approach, focusing on stable investments with lower potential returns. For others, it might mean embracing a higher level of risk in pursuit of greater potential rewards.
But regardless of our individual risk tolerance, a big part of making sound decisions is being honest with ourselves about our biases, right? I mean, we all have those tendencies to overestimate our knowledge or downplay potential risks.
Absolutely. Self-awareness is crucial. We need to be mindful of how our subjective experiences and perspectives can color our judgment. Take anchoring bias, for example. It's this tendency to fixate on the first piece of information we receive, even if it's irrelevant or misleading.
So if we hear that a stock is going to double in price, we might latch onto that prediction,
Yeah.
even if it's based on nothing more than speculation.
Exactly. We become anchored to that initial piece of information, and it can distort our perception of the actual risks and potential rewards involved.
Okay, so we've got internal biases to contend with, but what about external factors? How do we even begin to assess risk in a world that feels increasingly volatile and unpredictable? It's like trying to forecast the weather months in advance.
Well, one of the most effective strategies for navigating market volatility is diversification. It's the age-old wisdom of not putting all your eggs in one basket. By spreading our investments across different asset classes, sectors, and geographic regions, we can reduce the impact of any single event or market downturn.
So it's about building a portfolio that can weather those financial storms, so to speak, creating a balance of risk and potential reward across a range of investments.
Exactly. And diversification isn't just about minimizing losses. It's also about capturing capturing opportunities. By having exposure to a variety of assets, you're better positioned to benefit from growth in different areas of the market.
Okay, this is starting to make a lot of sense. So we've talked about defining our goals, being aware of our biases, diversifying our investments. Are there any other key principles we should keep in mind when trying to navigate this world of risk and volatility?
One that I think is often overlooked, especially in our fast-paced world, is patience. Investing is a long game, and it's easy to get caught up in the short-term fluctuations of the market. But remember, real wealth, true value, takes time to build.
It's like planting a tree. You can't expect it to grow into a mighty oak overnight. It needs time, nourishment, and the right conditions to thrive.
Exactly. And just like a gardener tending to their plants, we need to tend to our investments. That means monitoring their progress, making adjustments as made, but also trusting the process and not getting spooked by every little gust of wind.
This analogy is really resonating with me. It takes the pressure off of trying to time the market perfectly and shifts the focus to making informed decisions and letting them play out over the long term.
You've hit the nail on the head. It's about recognizing that sustainable growth in both our financial lives and in life in general is a gradual process.
So to recap, navigating risk and volatility effectively requires a multifaceted approach. It's about defining our goals, diversifying our investments, being patient, and perhaps most importantly, understanding the difference between the all and the infinite. It's a lot to take in, but it feels incredibly empowering to have these tools in our arsenal.
I agree. And while we focused on financial risk today, I think these principles can be applied to so many areas of life. It's about recognizing that while we can't control everything, we can make choices that empower us to navigate uncertainty with more confidence and clarity.
I love that takeaway. Before we wrap up our deep dive, what stands out to you as the most crucial aspect of this all versus infinite concept? What do you hope our listeners walk away with?
It's been an incredible journey exploring these ideas with you. We've gone from the nitty-gritty of financial markets to these big picture philosophical concepts. It's amazing how they all connect, isn't it?
It really is.
Yeah.
And for me, the most powerful takeaway is this idea that recognizing limits, embracing the finite, can actually be a source of strength. I mean, we're so bombarded with these messages about limitless potential, infinite growth, that we can lose sight of the boundaries that shape our reality.
You know, it's almost like those boundaries can be freeing in a way. Like once we accept that we're not going to achieve everything, we can focus on what truly matters and pursue it with more intention and clarity.
Exactly. Think of it like a garden. Without boundaries, a garden just becomes this wild, overgrown mess. It's that careful cultivation, the setting of limits that allows beauty and abundance to flourish.
Okay, that's a beautiful analogy. It makes me think about how we can apply this gardener's mindset to our financial lives.
Hmm.
How do we cultivate those healthy boundaries that allow us to take smart risks without getting swept up in the illusion of the infinite?
It starts with being crystal clear about your goals.
Yeah.
I mean, what are you hoping to achieve with your investments? Are you looking for long-term growth to fund your retirement? Do you want to buy a house in a few years, or are you saving for something specific, like your dream vacation?
It makes sense that our goals would kind of dictate how much risk we're comfortable taking and what kinds of investments we choose.
Exactly. Once you have a clear understanding of your destination, so to speak, you can start planning the route, taking into account the potential obstacles and detours along the way. That includes being honest with yourself about your own limitations, your biases, and your emotional responses to market fluctuations.
Right, we talked about those cognitive biases earlier, like anchoring bias or confirmation bias. It's so easy to get caught up in the hype and make these impulsive decisions based on emotions rather than logic.
That's why having a well-defined strategy is so important. It acts as the sort of roadmap to help you stay on course, even when the market is turbulent. And part of that strategy should include diversification.
Oh, we touched on diversification before, but can you remind us why it's so important?
Think of it as a safety net for your portfolio. By spreading your investments across different asset classes, things like stocks, bonds, real estate, and across different sectors and geographic regions, you reduce your exposure to any single event or market downturn.
So if one part of the market takes a hit, it won't wipe out your entire portfolio.
Exactly. And diversification isn't just about minimizing losses. It's also about capturing opportunities. By having exposure to a variety of assets, you're better positioned to benefit from growth in different areas of the market.
Makes sense. So we've got goal setting, awareness of our biases, diversification. Is there anything else we should keep in mind when navigating this world of risk and volatility?
One final principle, and it's perhaps the most challenging one to master: patience. We live in a world of instant gratification, but investing is a long game. It's easy to get discouraged when we don't see immediate returns, but real wealth, true value, takes time to build.
It's like those get-rich-quick schemes we see online. They're tempting, but they rarely pan out. Building wealth sustainably is more like planting a seed and nurturing it over time. You can't rush the process.
Exactly. And just like a gardener tends to their plants, we need to tend to our investments. Monitor their progress, make adjustments as needed, but also trust the process and don't get spooked by every little dip in the market.
This has been such an eye-opening conversation. I feel like I'm starting to see the world and my own place in it in a whole new light. We've covered so much ground defining our goals, diversifying our investments, understanding the impact of noise and bias, and perhaps most importantly, recognizing the difference between the all and the infinite.
I couldn't agree more.
Mm.
It's about embracing those limits, finding freedom within boundaries, and cultivating a mindset that allows us to approach risk with both prudence and courage. It's not about eliminating risk altogether. It's about understanding it, managing it, and using it to our advantage.
And that, my friend, is the essence of what COE 51s is trying to teach us. It's a message that resonates far beyond the realm of finance, wouldn't you say?
Absolutely. It's about living with intentionality, recognizing that true fulfillment comes not from chasing that illusion of the infinite, but from embracing the beauty and the richness of the finite reality that we share.
I think that's the perfect note to end on. Thank you so much for joining us on this deep dive into risk, volatility, and the power of the finite. We hope you found it as insightful and thought-provoking as we have.
It's been a pleasure.
And to all our listeners out there, we leave you with this final thought. What seemingly sure thing investments, trends, or beliefs in your own life might you be viewing through the lens of the infinite rather than the finite? Take some time to reflect on that, and we'll see you on our next deep dive.